Welcome to my video. I'll trust you'll find it helpful and informative. Please remember to like and subscribe. Thank you.
Learning Module 3 is about financial planning and control. Learning Module 3 is the reason I just said to you, please stick to what I'm giving you because the textbook is a complete disaster when it comes to Learning Module 3. And so you can, once I've updated the Word document, you can actually read through it and it will make sense. But there's a lot of the stuff in chapter 3 that is one, badly written, and two, wrong. There are two wrong formulas in the textbook, which I have fixed on the slides and in the Word document, so you don't have to worry about it too much. Only thing I want to look at now before we go this morning is business plan. So we're going to look at the convincing business plan and the business plan layout. So let's just talk about convincing business plan. So satisfying financier's requirement. The thing about your business plan, and remember, you are all preparing a business plan for us as part of your workplace POE. The purpose of a business plan is to convince investors or borrowers to give you money. So investors, investors are the people who are going to buy collateral in your company, and the borrowers are really the banks that you're going to approach for a loan, or if it's a funding requirement that you have, the organizations that you're going to approach to say, fund this project or this thing that I'm doing. Okay. So what are these people, these investors and borrowers looking for? The first thing, they must want to know that you are committed to this thing yourself. So they want to see your owner's contribution and they want to see if you have collateral. Okay. Because they don't want to be the only ones that are at risk. If you're showing the people you are approaching for money that you believe in the business and you yourself have invested money in the business and that you are willing to put up some collateral, then they are more likely to give you the money, because then at least the risk is being shared. You must use good financial arguments and a sound revenue model. Please, the one thing that will scare any investors off is if you are too optimistic when it comes to your financial arguments. If that old thing that if it sounds too good to be true, it's possibly not, investors feel the same about it. If you can go to an investor now and you say, please invest in my business, because in an environment where you are currently getting what, 5% from commercial banks and at most 10% on the stock exchange, I am going to give you a 15% return on your investment. They will say, yeah, that is fantastic. If you tell them that you are going to give them a 50% return on investment, they will say to you, oh, come on, are you crazy? There are people out there who are fantastic at business and they can only offer me 10%. Who are you to tell me that you're going to give me 50%? So even if you think you're going to give your investors a 50% return on investment, scale down your expectations so that it looks more sound and more reasonable, and then you will get the buy-in. Assure the lender that you can pay back the money by providing asset security. Okay, so so if you can't put in money, then you're going to put in an asset that you can. So that could be your house or a bond or something, or the machines that you're going to buy in order to start your production. Okay. Then what you need to say is what you need to show is steady cash flow that allows you to pay the loan over the agreed period. Okay, so if therefore your cash inflows are going to be very periodic, maybe 4 times a year, then instead of showing that on a monthly basis, then you show it on a quarterly basis, because then at least it doesn't look as if sometimes you're going to have no money for 3 months and then a lot of money for another month or something like that. Okay. Make realistic forecasts supported by hard facts. Okay. As I say to you, even if you need to be a little bit pessimistic, then do it. And then spell out exactly what you want to do in English. Okay, please. Some people, I don't know what they speak. It's some language that they have designed themselves to impress people. It does not impress anybody. Okay. Please use simple words and be very practical when you spell out what it is that you want to do. Show that you know the size of the market and the share you are targeting. Now, here I'm sitting with a training business. If I want to go to the bank, I can say, listen here, I sell business to business training. Every company in the country needs my training products. The South African economy is worth about 20 trillion a year. I want 1% of that. They're going to say to me, okay, you are crazy. Go away. If I say to them, you know what, I am going to target companies in a certain range with a certain turnover, and I have figured out that in my area there are maybe 2,000 companies of that nature. I plan to engage with 5 of them, and that will show, and that will be enough. Then they will say, oh, this guy is realistic. We can work with him. Okay. Impress the financier with the quality of your team. So you must have a team. And if you don't have a team, then get people to partner with you, even if it is just for the purpose of the business plan. Present financial forecasts that are as detailed as possible. So detailed budgets, we're going to look at budgets a little later. Okay, somebody's mic is on and they're speaking with me. So just check your mic, guys. Okay, and then be specific about the amount of money that you require. Okay, so that is what a convincing business plan is about. Then, how is this thing presented? Now, I did say to you, some institutions, many institutions, in fact, have their own template, but this is a guideline. So on the front page, you are going to put the name, your name of the company or the entity that you are doing it on behalf of, the logo, the details of at least the person that is presenting it or drafting it, the confidentiality clause and date. You want the confidentiality clause on the first page, because you can't have it on page 10 when somebody has already read the first 9 pages and then you say, oh, and sorry, by the way, I want you to sign a confidentiality clause. Therefore, you bring it in as soon as possible. Then the next page is the details page. So where you have all the necessary details that the financier will look for. Your name, address, postal address, your contact details, telephone numbers, physical address, who's your banker, who's your auditors, all of those things. Then the content page, which is a table of contents, figures, annexures, and page numbers. So everything that you put on a normal content page, but don't forget about your annexures and your figures. Then the next page is going to be your executive summary. Now, although it is the 4th page in your business plan, it is the last page that you write. It's not like you can do the executive summary before you've done everything else. You will do the executive summary after you've done everything else and then put it in the summary. That's why it's called executive summary. And in the executive summary, you are going to highlight the growth projections, opportunities, the competitive advantage, strategies, the profitability, and the management team. Okay, but you're doing it last. Okay, Then in your introduction, you're going to put the rationale. Why? That's the rationale. Why am I coming to you? Why do I want to do this thing? The vision, the mission, the goals, and the viability. Okay. Then in the business description, you're going to describe the product or service, the market, the competition. You can do a SWOT analysis. You will refer to the owner's involvement, look at the location, the ownership structure, and the legal requirements. Okay. Sounds like a lot, but really no more than 2 pages. Then you are going to do your marketing plan, where you're going to show your market segments, the potential of that market. How are you going to reach that market, and how are you going to be competitive? Now, please, when we do marketing, I can show you how to do a 20-page marketing plan. But for the business plan that you are going to do specifically, your marketing plan also one page, really. Then your financial plan. How much money do you need for startup? How much money do you need to buy assets? What's your income projections? How are you going to price your service or your product? Okay. What's your capital requirements? How much cash do you need? All of those things. Okay. And please, guys, do not assume when you write your business plan that you are going to start making any money or show any income within the first 6 months. Borrow enough money so that you can survive for the first 6 months. Okay. And then, of course, the ops plan. Who's the management, the employees? How is my structure? What am I actually going to do? That's operations. Okay. And the main thing is you must be able to indicate to the person that you understand the risk and that you have taken into account that it must be written in a way that summarizes everything, because people do not want to read 20-page documents, and then you must make your conclusion. So a good business plan has all of these elements, but it is still short enough so that it doesn't bore the person who is actually reading it. Okay. The next part is on budgets. Now, budgets are really part of this financial plan of yours. Okay, so let's therefore quickly look at budgets as well. Now, please look at it here. In the business plan layout, one of the things was the financial plan, and now we are looking specifically at that financial plan. Okay, so every financial plan starts with a sales budget. Okay, sales budget is income and expenses. Income projections must be more than expense projections to prove profitability. If it's not, then you extend the period so that you can do it. Income will normally come from just 1 or 2 sources, but businesses have many expenses. And so some of these expense categories will require further detailed budgets. Okay, so I've given you some examples there of your running budgets. Running means that you are going to spend money of this continuously. So that would be your marketing budget, your production budget, your purchasing budget, and your personnel budgets. Capital budgets are the things that are either project or for machines or driven like that. So here you have your fixed capital that you acquire and your fixed capital acquisition budget. With a fixed capital acquisition budget, what we are saying there is, remember, to borrow money costs money. So you must budget for that as well. Budget for interest and that type of thing. Okay, so I'm going to click here quickly and see. So now when you have your budgets in place, you must regularly compare the real income and expenses with the budgets. So step 1, you will say, this is the actual figure. Let me subtract the budgeted figure and see what the difference is. That difference we will call a variance. Okay. And now I say the variance is always positive. It doesn't mean that it's always favorable. It just means that you don't have to worry about the figure because you are looking at a percentage deviation. Yeah, I think I must just take this out. It's confusing. So let me just delete that to where I say it's always positive, because I know what I meant, but what I meant and what I'm saying is not the same thing. Okay, step 2. Then you take your variance and you divide it by your budgeted figure to calculate your percentage deviation. Okay. If your actual income is more than your budgeted income, then the deviation is favorable. Okay, and then the percentage deviation is positive. If it's an expense item, if your expenses is actually more than what you're budgeted for, then it is unfavorable, and then the percentage deviation will be negative. Let me show you here how it works. So now in the textbook, there was a lot of examples just to make you absolutely crazy and confuse you. I've just given you 3 examples because 3 examples explains everything. So here we have net sales. Our budgeted sales for the year is 80,000. Then we find that we actually sold 90,000. So I take the actual 90,000 minus the budget of 80,000, and I get a 10,000 Rand difference. It's favorable because it's an income budget and the actual is more than the budget, so you put an F next to it. So you take that 10,000 that you've now just calculated, you put it on top of your fraction, you divide with the 80,000, so you always divide with a budgeted figure, you multiply it with 101, and there you see, okay, so my percentage deviation is positive 12.5%. Okay, now your cost of sales, if it is directly related to your sales, will always be the same as your sales deviation, but will be negative. Because obviously, if you produce more, then your production cost is also more. Okay, so in this case, it is directly related. It does not always have to be. So here we budgeted for the cost of sales of 32,000. The actual cost of sales was 36,000. So actual minus budget gives me 4,000. It's unfavorable because I'm spending more money than I thought I would need to spend. Then I take that answer I've got there. Okay, put it there again. I divide it with the 32,000, which is the budget. I multiply with 100. Now I get a negative minus 12.5 because it's unfavorable. Okay, then my advertising, I plan to spend 9,000 on advertising. In the end, I only spent 8,000, so the difference is 1,000. It's favorable because I've spent less than what I've planned. I take the amount that I've just calculated, divide it by the budgeted figure, multiply it by 100, and then I get a number there of 11.1%.
Thank you for watching this video to the end. If you found it valuable, please subscribe and like. Thank you.